Let's talk about those recent acquisitions. Not a terrible surprise, but certainly it shows maybe a broader look that Blue Owl is taking at the industry right now?
It's a continuation of the Blue Owl strategy. Look, our DNA is pretty straightforward. Now, we've gotten large, but very focused. Our DNA is about delivering lower risk alternative products. That is to say, it's about protecting the downside and generating really attractive returns, generally with an income component for our investors. That's really the product suite we have. And when you look around that access, that solutions provider is the way we provide capital to deliver that for our investors. All of the things we've done wrap very tightly around that core.
And the importance of generating income, as you say, kind of ties in to the insurance deal, right? I mean, this is basically, I don't want to say a new market, but for a lot of folks, there are final alternative asset managers really starting to wake up to what you can get out of the insurance space, out of annuities.
Exactly right.
Yeah.
So from our point of view, having started nearly a decade ago with our business, we had two things we did really early on. We very early on worked on this focus of taking private credit from being a lender of last resort to a lender of first choice. And we did that by creating pathways for investors, institutional investors, and then we were very early in pioneering the wealth opportunity, individuals participating as true peers. Insurance is the third. Insurance is that third leg that allows us to tailor an access point for people that likewise want durable income, inflation-protected solutions. And at the end of the day, that's what private credit is. It's about creating durable solutions that generate an inflation-protected income stream.
Mark, got to ask you, everyone is chasing the insurance industry to help them put that money and cash to work. Having said that, regulators are a little bit worried. Why shouldn't we be worried about that and the involvement of private credit?
So Blue Owl is helping solve exactly perhaps that question, that quandary. Look, I think there's a lot of wonderful protections built around the insurance industry as is, and there's a lot of regulations built around what all of us do in this ecosystem. With that said, I should highlight that Blue Owl's approach, and part of what took us a while to take this step with regard to insurance, was finding something that was really distinctive. And what for us is distinctive is we're not getting into the insurance business. In fact, our partnership with Couvert is allowing Couvert to refocus all their time and energy on liability management and insurance and not on the asset management side, and allow us to focus on asset management and not bringing ourselves into the insurance business, which is not our core competence. So it's actually going kind of the other way, which is why don't we all do what we're really good at and focus our time and energy in that spot.
Having said that, what are the conversations that you're having with Couvert about how they want to see that money managed?
That's what any good partnership looks like, right? It's a dialogue. It's about working together on a common goal. And the beauty of that DNA I talked about with Blue Owl, our DNA is built around risk reduction, stability, and principal protection. But together we tailor what's that model, what's that allocation look like? And then they say, listen, your job, and hopefully we're good at asset management, you go do that so we can be the best insurance company out there. So it's really a very wise strategic choice, I think, that allows them to do what they're great at and allows us to do what we're great at.
Talk about the relationship right now that we're seeing with private credit managers, alternative asset managers, and the more traditional banks.
So people often like to set this up as a competition, what's happening in these fights, and I actually think that misses the more complete and important underlying principle, which is we in this country, globally, but this country has the most vibrant capital markets there are, and we need liquid markets and we need private markets. And a lot of people like to argue about the pluses and minuses to every hammer, everything looks like a nail, but the truth is, to have a vibrant economy, you need durable private solutions, and there's a big role that we provide, and you need durable liquid markets, and there's a big role the liquid markets provide.
Is the private side, is that providing the liquidity to the public market?
The private side is providing the durability to the market as a whole. I've been in alternative investments for nearly 30 years. And you go back 30 years ago, the alternative investments wasn't even a term. Private equity wasn't a term, but say LBOs or other things like it. Highly opportunistic, right? It was public markets would do almost everything, and then we'd show up and do one thing and disappear. Show up and do one thing and disappear. We were the opportunistic market. 30 years later, it's flipped. The private markets, what we do, we've been providers of capital all through COVID, all through when the Ukraine war started, inflation raged, when we had problems in the regional banks. Every step of the way, Blue Owl provided credit, And the public market is the one that's become the high amplitude in and out provider.
But do you really feel like the private markets have been tested yet? Especially if you think how much they've grown in just the last couple of years.
They have been tested. And this is one of those, hey, you never know sort of arguments that I'd say the antagonists sometimes like to make. We do know. We have decades of information on credit performance. The difference this time versus any other credit moment is we, as private lenders, have long-dated capital, so we will not have the liquidity mismatch that has often driven credit market problems. We've done more underwriting. We have stricter credit documents. We have lower loan-to-value. The one thing I think we can deduce from all the data, private credit will hold up better during the next downturn.
So, okay, but you know nothing's perfect, Mark, and you've seen a lot of investment cycles where we say everything's fine, everything's fine. What areas of private credit will get into trouble, in your view?
Nothing is perfect for sure. We'll be the first ones to acknowledge that. I'm sure I make a lot more mistakes than I do right choices. But what I am describing, I think, is an ecosystem that is durable, that is about matching long-term investors with long-term uses of capital. At the end of the day, the real problems come from mismatches of liquidity. And here in the private markets, what we're doing is matching long-term commitments of capital to long-term uses of capital. That's inherently more stable. That doesn't mean returns in every asset class will be good.
Right.
There are clearly places that are more economically sensitive that I would imagine everyone would be more cautious about. There are places, businesses that are more exposed to the geographic or the geopolitical risks we face today than others. Those are risks. I mean, I'll tell you that as our business, we've done almost $100 billion in loans. You know what our losses have been since inception? 7 basis points a year. Now, it can only go one direction from nearly zero, but the point is this model works over the time. Doesn't mean every person will work, every manager or every asset class, but the ecosystem of private markets are additive to the financial markets of the U.S.
About that ecosystem, and not to pile on, but just to piggyback off her question, we've also seen a lot more deals on terms of the liquidity side, where it's basically one private asset manager selling or buying from another private asset manager. That wasn't always the case. We had much more of an exit strategy that took these companies and these deals into the public market or into bigger banks. Why is that not still there?
Because the private markets have gotten bigger, deeper, and more reliable. And so people are often saying, the cost of being public, the quarterly treadmill, the daily treadmill in a quant market where things trade on the net.
It's a transparency there. I mean, you know what's going on because you have the books. But for those investors trying to peer in and figuring out whether they want to be here, is that transparency there?
Well, on the credit side, the transparency is very high because we run, as you know, BDCs, business development companies. Every quarter, we literally file a list of every loan we make. So the transparency in credit, private credit, is higher than it is in the banking system. You don't know what's on the bank's books. You know what's on our books. But in the private system writ large, there's no doubt a trade-off between liquidity and the return opportunity. There's a trade-off between transparency, which is a very positive word. I like transparency, but what I don't like is people having to make quarterly choices versus making long-term commitments to build better businesses. So all these things, to your point, nothing's perfect. It comes with trade-offs.
One has to assume that bad private credit managers will go out of business if they're not making good deals for their investors. I do want to ask you something, though, that you said on the call, earnings last week, you guys. Private credit firms are in good shape to withstand a sharp rise in loan defaults, despite fears that the young market has yet to be tested by a serious economic downturn. That's when we'll ultimately see the health or the problems in private credit, that we've got to have, a recession or something?
Well, let's hope we don't, but I think we should all plan for one. That's the way we operate. Listen, we live in a downside-focused world.
But I'm saying...
Yeah, so to speak, the elimination of managers that aren't doing a good job will come from that shakeout. I think we already can conclude the market writ large will be durable. The capital structures are sound, the borrowers are sound, and the responsible managers are doing a good job. But of course, indeed, some managers will prove that they were very marginal, and they will be shaken out of the system.
But with regards to that competition, and to bring up the conference call, I think you said this on the conference call as well. You gave this analogy of Blue Owl sort of being a car on kind of a northbound highway, and that offered some degree of differentiation from your competitors. Explain that to me.
So our business is focused, which is to say that we're not as broad. We're not trying to be all things to all people. We're trying to be a handful of things that match that DNA imprint I talked about. Lower risk products, strong returns, strong income, and do that by being a partner, a solutions provider to the other alternative firms, to the PE firms that you mentioned when we started, to the insurance partner we have. to wealth investors that are saying, look, I need something durable in this world, something special.
Yeah.
So we're looking at a series of lanes. It's not a single lane. I think there's risk to a single lane, because when you have one product, you tend to see the world through one lens.
Right.
We have multiple lanes, but they all tie together, and it's important for us to be the lead car or a lead car in those lanes.
But that narrowness here, you think that's going to work to your advantage, particularly as you scale? I mean, you guys are a behemoth now. You're not the new kid on the block. And, you're going up against, the big gorillas now who look at you and they see you as a threat. You know that, Mark.
Well, it's kind of you to say that. Yeah. I look at us still in the very focused fashion we are. Yeah. But listen, in what we do, we're very big. And when I talk about that northbound lane, the difference is I can take all my time and energies and go all directions in the compass, and I worry about that, not something we're going to do. We're on northbound lanes, and the result of that is we're very big. We are the #1 provider of GP strategic capital, GP stakes, by a country mile, to stay with kind of the metaphorical lanes.
Yeah.
Triple net lease real estate, same thing, by a country mile. In direct lending, one of the biggest few. So look, we lead those lanes.
Yeah.
It's just we're not trying to drive on every lane.
Yeah, and did you ever imagine this is what the lanes would look like 30 years ago, or however, when you
Would
started
not have known. It was a country road back then.
Yeah,
Are
definitely.
you talking about this at KKR?
Dreaming, perhaps.